Hello YouTube, welcome to Wall Street. In today's video, we're talking about the Japanese candlesticks, which is the most popular chart type used among traders, and how you can use this to up your trading, with better confluences for trading and the best confirmations for entries. If you're new to this channel, kindly subscribe, turn on post notifications to get more contents like this. Without further ado, let's dive into it. Okay, hello guys. The Japanese candlesticks. So basically there are two categories of the candlestick, which is the bullish and the bearish. Right here on my chart NZUSD, you can see the bullish candlesticks, which is depicted with the green, and the bearish candlestick, which is depicted with the red ones. And you can see that price on the bullish candlesticks is going higher. Right here is a bullish candlestick. You can see that it opened here and it closed here. That is price going higher. This big one here, it opened here and it closed here. This red one here, which is the bearish candlesticks depicting sales, it opened here and it closed here. So the bullish candlesticks and the bearish candlesticks is just representing price and where they opened and where they close. If the close is above the open, that means price is going higher from where it opened. If the close is above, that is a bullish candlestick, price went higher, so that's why it's green, and that's why it's bullish. If the close is below the open, that means price went lower, so that is the bear stepping in, price went lower, so that is the sell candles. As you can see, these red candles. So let's go to the anatomy for the beginners to show you how this actually formed in live markets. With this diagram here, this showing you a bullish candlestick. It's a bullish candlestick. It's bullish because from the first explanation I was telling you about, for the bullish candlestick, which means price is going higher, that means it opened below, the open is here, but it closed above eventually. The open and the close concepts, we'll dive into it later in the video, based on there are also different time frames for that, but let's just focus on this for now. So let's say price opened here, this candlestick opened here, but let's say this is a 5 minutes time frame. There are different time frames. There is the 1 minute, the 2 minutes, the 3 minutes, 2 hours. So this candle here was formed in the time period of 5 minutes, and it's opened here, this particular candlestick. That's why we have this low here. Sometime in the 5 minutes, price went down. That's why we have this low here. But this is the open here. This is the main thing that makes it bullish. The main thing that makes it bullish is because it finally closed above the open. And why we have this high and this low is because sometime in the 5 minutes, price went up, but the sellers also pushed it down, but they weren't able to push it down below the open price. So that's why it remained a bullish candle. So if it closed here and it left this wick here, that is the high wick. We call it the high. You can also call it the wick. You can also call it the shadow. This line here and this line here. Sometime also in the 5 minutes from the open, sellers were pushing it down, but it finally closed above. That's why it ended as a bullish candle. So in the day, you can also see this. If you go to the daily charts later in this video, I'll be showing you guys live examples. You can also see that on the day, the candle is also like this. Sellers also push it down, but at the end of the 24 hours, if it's ending bullish, that means buyers pushed it back up and the close is above the open. Let's show you a similar situation for the bearish aspect. And mind you, you can use any color, but the most popular is for the green for the bullish and the red for the bearish, which is representing sell. So in the bearish scenario, the most important is the open and the close. That means in the bearish scenario, price opened above here, but eventually the sellers were able to push price lower and it closed below here. And sometimes also they reached here. If it's 5 minutes candle, the sellers pushed it here, but the buyers also managed to push it here up and having this close here. That's why we have this wick. This is the high wick and the low wick. The high remains the same for the bearish and bullish concept, also the low but the only thing that changes and you should take into consideration is the open and the close. So this is the body of the candle. It also the same thing. There are some candles that, of course, like it has more wicks than the body. For example, this just outside, let's say a bearish candle that have this and have this body. That means there was a lot of trading between the buyers and the sellers, but at the end, if it's opened here, it's closed here, there is this also showing you indecision in the market, because the buyers and the seller are almost the same quantity. But we'll get into more concepts like this later in this video. So let's go to the live chart and let me show you some time frames, explain what the time frame means, and explain the concept of the 5 minutes, the 1 minute, and how it's traded in only one candle. So the time frame here, currently we're on a 1 hour time frame, as you can see. That means each candlestick here, Japanese candlestick, is 1 hour. That means this opened here sometime 11 o'clock and closed here. That means this is a lot of buy pressure, the big candlestick. Each candlestick here represents 1 hour. So if you have 24 hours here, that is 1 day. 24 of these candlesticks will be one candlestick on the daily. This is showing you 24 here. That means this is just 1 day. So we have the 15 minutes. Same with the 15 minutes time frame. Each candlestick here is 15 minutes time period. So that is it. We have the 30 minutes time frame. Each candlestick here is 30 minutes. So we need 4 to make 1 hour. So you can mix up your time frames for analysis to make a trading decision. And mind you that price doesn't just go one direction. Like if it's in a downtrend, let's say the day is going to be a bearish candle, it's not just going to go down all through. That's not how price moves. It's going to like have this type of corrections, but the main move is still heading down. This is just a retracement. Of course, here is going to be the bulls, the buyers stepping in to push price, and people now can like think that, oh yes, it's a started buying, but then this happens and they think it's a probability loss, but they don't know that the whole day was just sells. The whole trend is just downtrend. So as you can see here right now, this is the same concept. Everything is just downtrend. This is just a minor retracement from the bulls. You can see the green candlesticks. The main move is see the bearish move. So that is that. So we're going to step into the engulfing bar pattern. We'll go to the daily to show you some and how you can use this to help your trading. On the screen now you can see the bar pattern is simply where, let's say, a bearish engulfing bar. You can use this to get entry confirmation for a sell if you really understand where and when to look for it in the particular area of the market. Let's say you see a big bearish candle just after, let's say you see a big bearish candle like this just after a small bullish candle. Like I said earlier, these are used for confirmations and entries. Let's say you see this type of pattern, the bearish engulfing bar. Let's say you see this type of pattern on a support area. The bearish engulfing bar. Let's say you see this type of pattern on a resistance area. A big bearish candle just after a small bullish candle. This can help you get an entry confirmation to start looking for sales. And right here in this live market, you can see this one here. This an engulfing bar right here, and this is the daily chart. As a supply and resistance trader, this is supply zone here. So you can see after this bearish engulfing bar, you can use it to get confirmation for the daily trend. The next days was straight bearish, so this can be used with more confidences to get a trade. Let's look for it also in another significant area. We use these candlesticks in point of interest in significant area. We don't just care about any. I personally, I don't just look at the candlesticks at any point of the market. You don't need to be up all day looking at the 24-hour candlestick, maybe on a 1 hour. You don't need to look at all 24 candlesticks. You need to look for it at specific zones in the market where you can use it to gauge and get better confirmations, like the support and resistance areas. Like if you see this bearish engulfing I just showed you, bearish engulfing bar in a resistance, you see it in the supply, you know that the bears are actually coming in. You can use to get better confirmations for your sell entry. So we can also see another bearish confirmation, bearish engulfing bar right here. After 4 days of retracement by the bulls, we can see that this is a big bearish engulfing bar which engulfed the previous bullish candle, and then the next week was straight up sales. So this can help you spot the end of the retracements and the beginning of the continuation, and we'll go into in a more previous video how you can use it to build around your strategy, the patterns and stuff. So there's also the bullish engulfing bar. Of course, is the opposite concept. Let's spot a bullish engulfing bar. Here you'll be looking for a bullish candle that engulfs the previous small bearish candle. So you can see one right here. And what happened after this, we wait for a pullback and we got a beautiful retest of this resistance area. Of course, I told you to use these concepts I'll be teaching you in particular areas in the market, such as the supply and demand, the resistance and supply, and so much other concepts you can use this to up your trading with. So here you see the bullish engulfing bar was nicely respected, and for the next 2 weeks we can see higher prices. This is just for trading confirmations. There are other patterns also, as we'll be talking about it right now. We have the pin bar, the doji. The doji candlestick is simply represented like this, where the open and the close are on the same price. This is actually means that the buyers and the seller are indecisive, and there's a lot of indecision in the markets. As you can see, the opening price and the closing price are on the same place, which indicates that the market didn't decide which direction to move. You can also use this in significant areas like the support and the resistance. Also, when you see this type of doji, it means trend reversals in the market. So this is the doji. As you can see, opening price and the closing price are on the same line, which means that there's a lot of indecision in the market, and if you see it at the end of the uptrend or the end of the downtrend, it means that the market is likely to reverse. It's also used for getting the end of a trend. So let's spot the doji in the real market condition. So let's spot the doji in the main market condition. As you can see a doji right here. After this doji, we had, remember, the engulfing also. So this was a clean confirmation for buys, and you can see the strong impulse that the buy came with. This like up to 2 weeks. So this is a clean doji here. You can also see a doji right here. You can see a doji right here also, just before the reversal. So doji normally signifies that there is going to be a reversal. Normally, if you see it at the top or the bottom of a trend. So of course, all these patterns I'm introducing now, they respect time, because time is power. Like 1 minute, there's a lot of noise here. So you can see a doji on 1 minute and it means nothing. If the trend is a downtrend and you see a doji for a buy signifying bullish reversal, it's not going to be admissible, it's not going to be useful. So you need to also work with it with multi-time frame analysis using higher time frames, because a doji on a daily is stronger than a doji on a 4-hour, and an engulfing on a daily, bullish engulfing, is stronger than an engulfing on a 30 minutes, a bearish engulfing. So you need to build this around your higher time frames. So there's a lot of patterns. As you can see the pictures up, you can go in your charts and be checking them for practice, and know that time is power. Work with the higher time frame, because the higher time frame is going to be a signal on the higher time frame, a pattern on the higher time frame, a candlestick formation on the higher time frame is much more stronger than the one from the lower time frame. And there are times that it doesn't work, so of course you need to use your risk management always. I'm going to show you sometimes now that this doji won't work. Let's look for it on the daily. So I can go to a lower time frame and show you the example of what I was saying about how time is power. Let's go to the 15 minutes. You can see that there are sometimes a doji on the 15 minutes is just noise, as the 15 minutes has, and the 5 minutes, the 1 minute is the most noisy of them all. Most signals shown there are not respected. Most candle formations there are not respected at all. I'll advise you to use your candle formation from the daily, the 4 hour, and the 1 hour, and use the minutes time frame like the 30 minutes and 15 minutes for entries based on structure. So right here you can see a doji, but a doji at the top here. See a doji here, but of course the bears did not step in. Bears did not step in because the trend was still bullish on the high time frame and it still went up. If you took a sell here, it can easily hit your stop loss because this is the 15 minutes, and I say there's a lot of noise in the minutes time frame, but the daily are more likely to be obeyed and respected. The signals represented here. So you can use this for confidence in your strategy. The candlesticks, I personally use the hourly candlesticks for my entries. If you check our trades on the Telegram, you'll see that there's a lot of trades that I use my candlestick for. Like, let's go back to the CPI of this month, and that will be here. After I saw this H1 engulfing and this doji, I was already getting ready to buy during the CPI, and I called the trade, and you can see there was confirmation by the news. The fundamental confirmed the technical, and there was, you can see increase in prices. Price went up from the open here, it closed here. So that is just one way you can use your, of course this is just one of the conferences I use to call this trade, the engulfing and the doji there with the weak rejections, showing that the at the time from the open, sellers pushed it down, but the buyers had more strength and pushed it up, and it closed above. Adding with the doji and with my strategy confirmations, I was able to call this trade, and there are many more. Like here also during the CPI, during the NFP, sorry, I saw this. This is a pin bar. You can see the pin bar picture, the pin bar formation. I can see a clean pin bar. I can see another engulfing with this little candle, bearish engulfing, and I entered for the sell, and there was a straight push down, the fundamental confirming the technical, and this is a very sweet confluence for trading and confirmation for entries. I personally use it to navigate the market, and it's great. So the pin bar with the doji with the engulfing, these are just three very powerful candlestick patterns I'm sharing with you today. So of course there are limitations, as trading is about probability and good risk management. In using the candlesticks, you have the keynote you should take away is you should not work with candlesticks patterns from 15 minutes below. You should just use it for the structure and use it for small time frame entries. But daily candlesticks is a very powerful one, the hourly above, and also you need to work with them in particular point of interest zones. Here was a demand. I not just come in the middle of the market and was looking at an engulfing. That does not make sense at all, and it's not advisable at all. So you work with particular points in the market, particular point of interest, using this as the best confluence for entries in trading. Of course, I always say that technical analysis, there's nothing new in technical analysis and nothing is going to change. So you can see also this an engulfing here, and this was a continuation after this retracement, because some people now will want to sell from this supply, but after this engulfing, knowing that it's still bullish, this was a confirmation to either for get in and continue riding the buy, or if you're selling, you get out of the market. So the candlestick is a very good confirmation for entries and confidence for your trading. Pay close attention to the candles formed at these particular key zones, your supply, your demand, your support and your resistance, your trend lines, to see how they react to it, see how they break it, and this will really help your trading, and this will really help your trading 100%. Alright guys, that is it for this video. Don't forget to like, subscribe, turn on post notifications, as we'll be seeing you in the next video.